Hey everybody, Mike DeSepoli. Welcome to Heritage Insider Weekly for Friday, March 17th, 2023. Hope you're all having a great week. We're back to update you on the situation that has been developing this week in the financial markets regarding the banking sector, as well as markets in general. We've had a very interesting week for markets. While markets are down today, they've actually been pretty firmly positive this week, which I don't think most investors would have expected given the crisis that we have seen unfold in the banking sector. So we want to go through some of the things we noticed this week in the markets. Also, looking ahead to next week, we know we have the much anticipated Federal Reserve meeting Tuesday, Wednesday, with the policy announcement on Wednesday. And while there was, an absolute certainty a week ago that the Fed was going to raise rates and do so probably at a larger clip than last month, then the banking crisis unfolded. It threw a lot of doubt into the future plans for the Fed, some suggesting that they may even stop or pause hiking rates. And now we have an article here today suggesting, again, no guarantees, but suggesting that the Fed is poised to approve a quarter-point rate hike next week. So even though we are tired of interest rate increases, like everybody else is, I think this is the right thing to do. I think this is the right message. And the reason for that is the Fed is basically reaffirming the commitment to battling inflation, right? And that's part of the big challenge is getting the market and market participants to believe the Fed that they are serious about fighting inflation. Now, we know they're trying to fight it, but they've had a lot of miscues along the way, saying things like transitory, giving really bad target projected ranges for the Fed funds rate. So naturally, the market, is kind of in an approve it type of mood to Jay Powell, right? We hear what you're saying, but prove it to us. So I think a quarter of a point next week would send the message that we're committed to the inflation fight, and we don't see enough problems in the banking sector right now that require us to deviate from our path. So we think that's a good thing. But nonetheless, markets will be volatile as one would expect. So get that out of here. So let's take a look at the markets. Okay. First, let's move it in. We want to look at this week. So here's this week, right? Kind of an odd situation, right? Last week was very weak in the markets. A lot of fear building up. Coming into Friday, where we went out into the weekend down around 3840 on the S&P. And while this week has been very choppy, a lot of volatility, markets have moved higher, including a big rally yesterday. When we zoom it out a little bit and we take a longer view of things, this level that we have keyed upon really for the last month or so in our videos has really turned into be quite the battleground as we would have expected, right? There's a lot of supply and demand around these levels. And if you've been following along, we started talking about this area in the purple box when the markets were still up here around 4150, that this was the inevitability that markets would retrace to this level. Now, it's what they do at these levels that are very important. And so far, it's really hard to tell, right? The market hasn't just knifed right through it and continued lower, so that's a good thing. Neither have we bounced off it and continued higher. So I think there's a case to be made in this market for both sides. Bulls or folks who are optimistic would make the case that the market has just digested a ton of bad news and now sprinkling a banking crisis there, and markets are mostly unchanged, right? And I think the bears would argue that there's still a lot of inflation in this economy. The Fed still has a ways to go, or hypothetically speaking, and the fact that when you look at a banking crisis, it doesn't tend to end in a couple days, right? So there's something for everyone in this market. When you look at individual components of this market, they send very different messages. So we know that yields were rising really for the better part of the last year and a half until the banking crisis unfolded. And now we've seen the 10-year yield just get absolutely crushed. And for that reason, we have started to see more of a bid in tech stocks, right? So if we looked at the market this week, I'll just move myself around, this is 1 week performance for the market. Okay, markets as a whole have been up, but it has not been evenly distributed across the board. When we look at where have the gains been concentrated, it has been in tech, right? Look at some of these moves. When you look at tech, Google, Microsoft up 12+% this week, Amazon up 9%, Meta up 10, Apple up 5, right? And the narrative here is people want to know why are people bidding up tech stocks when there's a banking crisis going on? Well, it's twofold. Number one, because they're not bank stocks, and number two, because tech has been under pressure as interest rates have gone up. So it would be natural to see that it's got a tailwind as interest rates come down, even if in the short term, right? The 10-year yield has fallen very quickly, and we've seen tech stocks rise on the back of that. So that's something very important that we want to watch. And also the sentiment in this market, as you would expect, has shifted dramatically, right? So, just probably 3 short weeks ago, the market was in the greed, bumping up against extreme greed category. And a month ago, we were at greed. And now look where we've moved, right? We've gone to extreme fear, which is what you would expect. It's the type of activity you'd expect with a banking crisis running through the economy. So investors are naturally scared, which is good. That means that they're not over exuberant and just kind of brushing off what's going on. They're seeing it, they're acknowledging it, and they're feeling it. So I think from a contrarian standpoint, seeing bad sentiment or seeing low sentiment would suggest markets can maintain a little bit of a firmness at these levels. And another thing we wanted to point out, if there is if there is a recession coming, if there is a market crash coming, somebody has not told NVIDIA about this, okay? And the reason I bring up this one particular stock, aside the fact that it's owned by us, semiconductors tend to lead the economy. Semiconductors tend to lead tech. And NVIDIA has been an unstoppable force since the October low. And when you compare it to the S&P 500, the performance is nowhere close, right? You look at NVIDIA up about 140% since the October low. The S&P is up about 6%. And even more importantly, you look at this week, right? This stock has just not stopped going higher, which obviously is something we like to see. But very interesting, because if there's problems around the corner, the semiconductor space does not appear to know about it, okay? I mean, today you're getting a little bit of red, but AMD, same thing, just a phenomenal week in some of these semiconductor stocks. I think that's important to note, because either they are confused and they're going to play catch up in the other direction, or the semis know something about this economy that the rest of the market has not figured out yet. So all in all, let's just go back to the S&P 500 here. We think we are still in a holding pattern. The markets are working through this. They're challenging this area, as we discussed. We didn't think it was just going to be one quick battle and moving out. I think this is the type of tug of war that you generally tend to see. But overall, markets are still holding above key levels, right? They're well above their October lows. We're still below that key resistance of 4,200 that's above us. And now it's on to the next thing, right? We got through earnings season. That was supposed to be horrific. It wasn't. Now we have this banking crisis, which is still really ebbs and flows. We're dealing with that as it comes. It appears for now the risk is contained. It's not widespread contagion. So I think investors are, taking a little bit of comfort in that. But again, right, I guess it really just, sums up the way the market's been for 2 years, where nothing makes sense. And now we have a banking crisis, and the market goes up for 4 of 5 days this week. So barring any catastrophic changes between now and the close, which is about an hour and a half away as we record this video, markets will have and close the week higher this week. So I think that's something that if you had asked people on Sunday night, as the bank failures were running around through the economy and through the news cycle, I don't think anybody would have expected that. But markets love to surprise people, folks. So if you have any questions, reach out to us. Always here to talk to you about anything that's on your mind. Hope you have a great day and a great weekend, and we'll see you back next week for Heritage Insider Weekly.